Welcome back. Well, on to the fourth headline for this evening. The best is yet to come. That's the word coming in from Puneet Chhatwal of Indian Hotels. He said that he expects demand to outpace supply this festive season. He added that the company will open more properties abroad, but will only manage the assets and not buy them.
The sector has proven its resilience despite COVID. And within the sector, we are the largest hospitality ecosystem. And I think we are very well positioned to take advantage of what I say the best is yet to come. And with the G20 planned as of December, with India getting the leadership, I do think there'll be some kind of incremental demand, which we don't have in normal years. So yes, given our new brandscape or the reimagined brandscape, given our diversified portfolio, I think we are very well positioned. It should be one of the better Q2s that we have witnessed as a hotel industry in the last 5-7 years.
Okay, well, let's get to the fifth story then. Today, specialty chemical stocks like Tata Chemicals and Aarti Industries were in focus on the back of a Morgan Stanley note. Nimesh Shah is here with the highlights of that.
As you rightly pointed out, both are seeing sharp reactions on the back of that Morgan Stanley note. Today morning, they put out a note on specialty chemicals, and in that, they've double upgraded Tata Chemicals to overweight from underweight, and they've sharply raised the target price there to 13.19 from their earlier target price of 8.50. That is on Tata Chemicals. On Aarti Industries, they've double downgraded to underweight now from overweight, and there they've got the target price sharply to 6.85. I'll come to individual reasons as well. They also mentioned about Deepak Fertilizer. They've marginally cut Deepak Fertilizer as well from equal weight to underweight, and there they've cut the target price to 17.32. The top pick within the specialty chemical space is SRF. There they have an overweight stance, but they've sharply raised the target price on SRF as well to 35.71 now versus the earlier target price of 27.50 odd levels. Now coming to specific reasons on the downgrades and upgrades. First on Aarti Industries, the double downgrade is largely on back of reflecting material constraints and slower project ramp up. That's been the key reason for downgrading Aarti Industries. For Deepak Nitrate, the key reason is they're seeing limited visibility on phenol and demand risk in key segments for Deepak Nitrate, and hence a notch downgrade to underweight now. On Tata Chemical, the key reason for the big double upgrade to overweight is largely on back of sustained tightness in the soda ash market, as well as the fact that the company is doing better cost controls across the board. So the numbers are going to be quite strong for Tata Chemicals going forward, and hence a double upgrade on Tata Chemicals. Coming to the overall industry, Morgan Stanley is seeing a $25 billion opportunity till 2025 for these specialty chemical companies. One, they're going to benefit from the China factor, the shift from China, and two, the second leg of rally will come from upside will come from the Europe One strategy. So a lot of the European companies are going to face trouble, which means the production will shift to India, and that's where the big benefit will come for this Indian companies. So on back of that, between FY22 and FY25, Morgan Stanley is expecting a 22% profit CAGR for these companies, even though there's going to be some moderation in demand and there will be some product margin pressures as well. So two big calls from Morgan Stanley today: a double downgrade in Tata Chemical, and double upgrade on Tata Chemical, and a double downgrade on Aarti Industries.
Okay, all right, Nimesh. Thanks very much for that. So a lot taking place within the entire chemical space. But let's move on. Godrej Consumers ended the day 3% in the green. This is after it looks to expand its Africa portfolio. Manglam is here with the details.
Well, Godrej Consumer did well in today's trading session, and that's primarily on account of the conference call that it held with investors yesterday, specifically on their Africa business. Remember, their Africa business has been growing in double digits for the last 8 quarters, and now the management believes that the next leg of growth will come in from them actually widening their portfolio and adding more portfolio products to the pipeline, the distribution pipeline that they've expanded in Africa itself. Importantly, they believe that margins could be anywhere between 15 to 17% in their Africa business, and the analysts like that. So we had brokerage comments coming in from Jefferies, Credit Suisse, Morgan Stanley, all of them actually having favorable ratings on the stock with target prices ranging between 975 to around that 1100 rupee mark as well. But not just Africa. If you take a look at the India business as well, the second half of this year is extremely crucial for the entire consumption space, and Godrej Consumer in particular, because one, their key raw material for the soaps business, which is palm oil, has been at a 52-week low, so that could mean margins would expand in the second half. And secondly, 60% of India's consumption, a little more than that, happens in the second half of this year post-monsoon, so that should augur well for the top line for the company as well. The only two problems that the company needs to resolve is one, the weakness that we're seeing in their Indonesian portfolio, and the second one is the weakness that we're seeing in the household insecticides category for Godrej Consumer. These two verticals have been weak for the last few quarters, so any improvement on that front is something that the street would like as well. It's perhaps because of this weakness that the stock trades at a discount to the sector at around 37 times 1 year forward earnings, but if these are fixed, then maybe the valuation support would take the stock even higher from here.
Okay, all right, Mangalam. Thanks very much for that. On that note, it's a wrap on this edition of Markets Today. Thanks very much for watching.